Hello everyone, welcome to Concepture Academy. In today's lecture on the accounting cycle, we will learn how financial data flows through the steps of accounting from the first transaction to the preparation of final accounts. So let's start with what is the accounting cycle. Actually, it is the complete process used to identify, record and summarize a business financial activities during a specific period. And the cycle ensures that a business maintains accurate records, follows accounting rules, and prepares reliable financial reports for the decision making. Now let's look at the steps in the accounting cycle. There are 9 steps. The accounting cycle starts with identifying and analyzing transactions. Then we record them in the journal and post them into the ledgers. After that, we prepare a trial balance and make adjustments, and after adjustments, prepare the adjusted trial balance. Then we move towards preparing the financial statements, and finally we close the books and prepare the post-closing trial balance. So these are the main steps of the accounting cycle, and don't worry if it looks like a lot. I will explain each step in detail one by one in the coming discussion. The first step in accounting cycle is to identify transaction. Any activity that affects the financial position of the business, like selling good or purchase of anything or paying salaries, is a transaction. After identifying business transactions, the next step in the accounting cycle is recording them in the journal. Remember, transactions are always recorded in chronological order, means in the order they happen. And for each transaction, we use the rules of debit and credit. So let's take an example of a business named Bright Traders in July 2025. On July 1st, first transaction happened. The owner started the business with cash of 50,000 rupees. Here cash comes into the business, so we debit cash. Owner's capital is increasing, so we credit capital. So the journal entry will be cash to capital account. Second transaction happened on July 3rd. Purchased office furniture for rupees 10,000. Furniture is an asset, so we debit furniture account. Cash is going out, so we credit cash account. The journal entry will be furniture account to cash account. Third transaction happened on July 5th. Paid rent rupees 5,000. Rent is an expense, so we debit rent account. Cash decreases, so we credit cash account, and the journal entry will be rent to cash account. So this is how we record transactions in the journal using debit and credit rules. We will keep practicing with more examples so you get fully comfortable with the process. Journal entries are then transferred to the ledger. This is where we group similar transactions under the same account name. So let's continue with the same example from step 2. We had this journal entry on July 1st, 2025. Owner started the business with 50,000 rupees in cash. So now we open two ledger accounts. One is cash account, the other one is capital account. Cash account is debited in the journal, so we will write capital account in the particular column on the debit side of the cash ledger. For the capital account, as it is credited in the journal, we will write cash account in the particulars column on the credit side of the capital ledger. Remember that ledger shows each account separately, unlike the journal where both are in one entry. So every ledger account will eventually be used to prepare a trial balance. Next, we prepare a trial balance. It is actually just to check the accuracy of our records. If total debits and credits match, we can proceed confidently. Now let's talk about adjusting entries and adjusted trial balance. Adjusting entries are very important because they make sure that revenues and expenses are recorded in the correct accounting period. In other words, they ensure that financial statements show a true and fair picture. Common types of adjusting entries include outstanding expenses, prepaid expenses, depreciation, and unearned revenue. So let's see an example to understand this better. Suppose Bright Traders received 6,000 rupees in advance for providing services for 3 months. At the time of receiving cash, the service has not yet been provided, so we cannot treat it as a revenue. So the correct entry at the point will be cash to unearned revenue of rupees 6,000. Now after 1 month, the business has actually earned 1 month's service revenue. So since 1/3 of the advance is earned, we need to adjust that. The adjusting entry will be unearned revenue to service revenue earned of rupees 2,000. So this shows that 2,000 rupees is now recognized as earned revenue and the remaining rupees 4,000 is still a liability until the services are provided. So the key idea is adjusting entries shift amounts from assets or liabilities to expenses or revenues as they are used up or earned. So after making all these adjustments, we prepare the adjusted trial balance, which then leads us to the financial statements. Now we are ready to prepare the financial statements. These 3 financial statements tell the financial story of a business. Each one shows a different aspect of the performance. Income statement, balance sheet, and cash flow statement. Income statement tells us how much profit or loss the business made during a specific period, say month, quarter, or a year. While balance sheet presents the financial position of the business at a specific point in time. Cash flow statement tracks the inflow and outflow of actual cash through operating, investing, and financing activities. Now we move to the last steps in the accounting cycle, closing entries and preparing post-closing trial balance. Think of closing entries like cleaning up after a party. All the temporary accounts like revenues, expenses, and drawings are closed and their balances are transferred into capital account or retained earnings in a company. So why do we do this? There are multiple reasons. One is to reset revenues, expenses, and drawings back to zero so the new accounting period starts fresh. Another reason is to update the capital account with the net profit or loss for the period. Let's look at the process step by step. First of all, we see how we treat revenue accounts. Revenue accounts would be closed against income summary account by following this transaction. Revenue account would be debited and income summary account would be credited with whatever amount that is there. Then closing of expenses account. Income summary would be debited and expenses account would be credited. Here there are 2 types of expenses, rent and salaries expense. Then transfer net profit or loss into income summary account again. If there is net profit, income summary account would be debited and capital account would be credited. If there is net loss, capital account would be debited and income summary account would be credited. And then finally, we close drawings if there are any. Capital account would be debited and drawing accounts would be credited. So at the end of this process, all the temporary accounts have zero balances. That means they will not appear in the post-closing trial balance. The only accounts left are the permanent ones, that are assets, liabilities, and owner's capital. Here remember a thing, the capital account is a permanent account and it is never closed. It carries forward from one accounting period to the next, reflecting the owner's equity in the business over time. So closing entries complete the cycle and prepare the books for a new fresh accounting period. Let's have a quick recap of what we have learned today. From recording the first transaction to preparing the final reports, accounting follows 9 key steps that involve identifying, recording, posting, adjusting, and final reporting. So each step ensures accuracy, transparency, and reliable record keeping, turning everyday business activities into clear financial insights. So it's a complete journey of transaction from entry to the financial statement preparation. That's all about today's lecture on accounting cycle. Now you would have an idea that how important this cycle is, and it is very important to follow the sequence in which these all 9 steps move. So let's keep learning. Subscribe to Concepture Academy for more clear and simple lessons, and also follow us on Instagram and Facebook, and please leave a comment and tell us what you want to learn next.